Hi everyone, welcome back to my channel. Today I would like to talk to you about why you should start investing early in the stock market. Without further ado, let's get to it now. Do you know that the stock market is a well-oiled wealth generation machine for those who start investing early and stay in the game the longest? In the past, I have covered a few stories of how normal people create generational wealth on my channel, links below. Today, I would like to focus on a few simple charts that I came across from money.usnews.com. Link below also, to show you when you start investing matters more than how much you invest. Before I start, let me introduce you to three investors who have started their stock investment journeys at different stages in their life, but with the same contribution monthly. The first investor, his name is Jack, the investor veteran who started investing at age 25. The second investor is Jill, the responsible one, who started investing at age 35. And the last one, but not least, is Joey, the late bloomer, who started investing at age 45. Let's talk about Jack first. Jack has been studying stock investment, and he learns that starting early will give him a leg up. So he starts investing $200 per month when he was 25, and he keeps contributing till he turns 65. And Jill, the responsible one, doesn't start investing $200 a month till she was 35. And like Jack, she keeps contributing till she turns 65. As for Joey, the late bloomer, doesn't start investing $200 a month till he was 45. Like Jack and Jill, though, he keeps contributing till he turns 65. Here's the recap. Jack, Jill, and Joey have all invested $200 a month in the stock market till they turn 65. But they start investing at a different age, and the result is astounding. Let's look at Jack's result first. The total contribution for Jack is $96,000, and he has about 40 years in the market. By age 65, his portfolio is worth more than $520,000. The total contribution for Jill is $72,000 in total, and she has 30 years in the market. Her portfolio is worth about $245,000 when she turns 65. By waiting 10 years to start, she ends up with less than half of what Jack accumulates. Joey, the late bloomer, total contribution is $48,000, and after 20 years, he only has about $100,000 in his portfolio. Here's a close-up of their investment outcome, and I base their annual investment return rate of 7%, which is very doable. If you have enjoyed my video so far, please share, like, and subscribe to my channel. Thank you. Do you know that time invested in the stock market is so important that Jack can even stop adding to his investments and still have more money than Jill at age 65? If Jack were to contribute $200 a month from age 25 to 35, he will be contributing about $24,000 in total over 10 years, and his investments would be worth almost $300,000 at age 65. If Jill continues to invest $200 a month between age 35 and 65, her contributing total over her lifetime would be about $72,000, which is 3 times as much as Jack, but still end up with only $245,000 at age 65, even though she contributed for 30 years because she missed those first 10 years of investing. Jack still comes out ahead. Understanding this really blows my mind. When your investment earns more money than your contribution, Jack is able to stop contributing at age 35, but still accumulates more than Jill thanks to the power of compounding. At first, Jack's $200 monthly contributions don't earn much interest, $14 in the first year and $30 in the second year. But by his 11th year of investing, his money is earning more than he puts in. Jack contributes only $200, but he earns $231, and it will only go up from there. Over time, his earnings will exponentially exceed his contributions. The secret to financial freedom is when your money makes more than you save. Jack is able to stop contributing at age 35, but still accumulates more than Jill thanks to the power of compounding. Let me show you what I mean. Jack's earnings will grow so large, they will exceed all of his contributions combined. After 20 years of investing, Jack's combined contribution total is about $48,000. That same year, his $48,000 earned over $56,000. By year 25, his earnings, which is $103,000, are over 70% larger than his total contributions, which is $60,000. This is why time is so important in investing. Given enough time, your earnings can compound to take on a life of their own. Even better is that they can become self-sustainable when your money is earning enough money that you no longer need to work. You have achieved financial independence. Small contributions can become big earnings. Jack is able to stop contributing at age 35 but still accumulate more than Jill. It's because of the power of compounding and his time in the market. I may be small, but I am mighty. When you start investing, it can feel like your efforts are all for nothing. But after 5 years of investing of $200 a month at a return rate of 7%, you would have put in about $12,000 a year and earning about $2,400. Over time, those earnings compound until the amount you contribute looks paltry in comparison to your returns. If you keep investing that $200 every month until age 70, for instance, you will have contributed about $120,000, but could have amassed almost $976,000 in earnings for a total portfolio of $1.1 million. Invest more and grow more. Jack is able to stop contributing at age 35 but still accumulates more than Jill. I don't know about you, but it sounds pretty good to me. Here is the chart to show you the benefit of increasing your contributions. You don't have to start investing $1,500 a month right away. It's okay to start small as long as you start. You can always increase your contributions later. Say you start with $200 a month. If you maintain those contributions for 40 years, you could accumulate about $500,000. But if you were able to increase your contributions by 5% each year, your portfolio could grow to more than $1 million in that time frame. Just imagine how much you could accumulate starting with $200 a month and increasing your contributions by 10% each year. You won't believe this. The outcome of your portfolio would be more than $2.6 million in 40 years. If this is not a good incentive to up your contribution, I don't know what would be. The purpose of this video is to encourage you to start investing now. There's a saying, the best time to start investing is yesterday and the next best time is now. I hope that this video has been educational and helpful. I hope that you learned something new from this video. If you do, please support my channel by sharing, like, and subscribe to my channel. Until then, we will see you next time. Thank you so much for watching. Bye!